Hi, I'm Khleif. Each and every week, I record an interview with a thought leader that I know you're going to get a ton of value from. Now, here on YouTube are the video versions of my podcast, Lifetime Cash Flow Through Real Estate Investing. Now, to make sure you get the latest information, please subscribe and hit the notification bell. Let's get started. Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Khleif, and I'm thrilled you're here. I know you're going to get great value from the gentleman we're interviewing today. He's a super nice guy. His name is Josh Eitingon. And Josh has been in over 350 doors in multifamily, also does retail, has some retail properties. He's a co-founder of DXE Properties from Long Island, but they invest in the Southeast now, and we're going to dig into all of that. Josh, welcome to the show, brother.
Thank you. Good to be here.
Yeah, so let's have some fun. So Josh, maybe you can start by talking about how you got into real estate. I mean, we'll do the kind of the history on you because I really didn't dig into that at all. So talk about why real estate, maybe where you came from and how you got to where you are.
Sure. So I, going back to college, I was always drawn to, maybe it was the simplicity of real estate. I think I started like a lot of people did with Rich Dad, Poor Dad, reading that book on the train on the way to and from work. My intention was to buy a two-family house and to live in half, rent the other half. It just seemed like it was a very logical first step for me. Through all sorts of networking and just being out there at different RIA events and a lot of different places, I was connected to someone that I really liked who became a mentor for me. And he encouraged me right out of the gate to go a little bit bigger. And ultimately that pushed me and my first deal he connected me to a property manager out in Cincinnati who showed me a bunch of deals. I built a level of trust with him and leaped with my first deal being a 20-unit deal in Cincinnati while I was still working full-time for a software company out of college, basically.
No kidding. Okay, so you actually bought out of your market. You and now you're in excess of 350 deals. I know you've you've founded your own company. Then you founded another company. It looks like, and you've progressed. I assume now you're doing larger deals. Is that an accurate statement?
Yes, it is, and we are. I'd say that first deal was a great step in, and I learned, for better or worse, a lot along the way on that. I did, after a few years and after that first deal, made the transition from my software role into a real estate acquisitions role, or first an analyst and then an acquisitions person.
Oh, so you actually went to work for someone on their acquisition side?
I did, yes.
Okay, fantastic.
And then I borrowed whatever I could and the relationships I made out of that, particularly on the acquisition side, to really get deals in front of me that I felt were compelling.
Okay.
So that was really our trigger and our leap for DXE, just a handful of good, solid deals to be our base that we're now building off of.
Okay. So back to that 20 unit. Let's go back there because I have a lot of listeners that haven't bought a property yet. So why out of state? Number one. Number two, how did you select Cincinnati? And then what prompted you to pull the trigger on that deal?
So in hindsight, I don't know that I'd do that deal again, but
okay.
It did get me in, so I couldn't be in without it. I was drawn to it. Look, I was fortunate. It was 2012, so most of what you bought in 2012, you couldn't really mess up too much on. But just the mentor, he was doing a lot of flipping in Cincinnati. He owned a few multifamily deals out there. And this property manager was someone that he worked with. And frankly, for no other reason, I was comfortable with that. Okay. I do think Cincinnati has a decent story in terms of just diversified employers. There's a good population base, solid demographics. It's not growing like a Charlotte, but there's a good positive base of people there. Mm-hmm. But I'd be lying if I said it was anything beyond comfort on the relationship. Got
it. Okay. All right. So that's probably not the one we want to use as an example then. So, because you relied on your mentor, but let's say this,
do you see the value in having a mentor in this business?
Totally.
Yeah.
I absolutely. If at a bare minimum, just as a voice in the back of your head, identifying that, is this a real issue that I'm minimizing, or is this not an issue that I'm maximizing? I think that little push in the right direction is extremely valuable.
Good. Okay. So I know that was that the only property you bought there in Cincinnati? Everything else has been elsewhere?
No. Let's see. The second deal was a 44 unit deal, also in Cincinnati. A little later, did a 62 unit deal in Northern Kentucky, which is it's like
effectively Cincinnati as well, right? Okay.
Exactly. And then we went on. Really, all of the acquisitions after that have been Southeast focused. So parts of Florida, Atlanta, Carolinas.
Okay. So you obviously use third-party property managers?
Right. Correct.
Okay. And so what caused you to make the shift from Cincinnati? Was it a partner, and how did you select? Where was the first other state that you bought in?
It was Florida.
Okay, where in Florida? Obviously that's my backyard.
Panama City.
Panama, I love Panama City. I love it. Yeah. I haven't been there in a long time. Beautiful beaches. So what did you buy there?
70 unit Cardinal deal.
Awesome. What do you mean by Cardinal deal?
Sorry, it's the type of construction is Cardinal style. So single story. It almost has a manufactured housing type of look to it. A lot of them were built in the 70s and 80s. They were almost built as the affordable renter unit. They all have these PTAC units that do heating and cooling through the wall. And they're all very, very small, efficient units. They were meant, again, as for renters or for the owners, where you could almost buy parts and everything out of a catalog. At least that was the thought process back then.
Interesting. And why? So how did you find that? How did you select Panama City? Were you being a generalist and just looking for a deal wherever you could find it, or did you target Panama City?
So at that time, I was more story and deal driven, whereas I would look at a deal and then back into the market. Versus these days, we're more so the opposite, where we're really only looking at maybe 8 or 9 cities total, and not looking elsewhere.
Right.
But in that case, that was through a broker that I had worked with on the acquisition side when I was working for the larger investment company. And he knew that I was interested and did smaller deals, and he put it in front of me because there was a good motivation, a group that just bought it at a year before in a big portfolio that had all different types of asset classes. And this just wasn't in there. They were more so in the industrial space and office space, and they were happy to peel this off. They bought it at some level of distress, and let us do the heavy lifting, so to speak.
Nice. Now you like value add deals, yes?
Yes.
Okay. So now you're tell me the markets that you love and you're most heavily vested in now.
Sure. So right now we have 3 deals in Charleston, South Carolina. Doing a project in Charlotte, North Carolina. We know Greenville, South Carolina very well. Even Raleigh, Durham area, we also know very well. Open to Atlanta, admittedly not competing especially well in Atlanta, and same with Jacksonville. And lastly, actually not far from you, we've been spending some time in Tampa, but also having a tough time competing in the Tampa St.
The Tampa, Atlanta are tough. Don't get me wrong. We just we're always looking. We haven't even taken anything down in Tampa ourselves. We're closing on something in Sarasota here shortly, but it's tough. But listen, I love every market that you've identified. So tell my listeners what you look for in a market now, the sorts of demographics you look for, and then maybe we'll drill down on really what you're looking for in an asset.
Sure. So strictly from a population perspective, we won't look at any MSA that's less than, I'll say 500,000, but we're really looking to be closer to 1 million.
Mm-hmm. Okay.
We are definitely looking for diversified employers, employment base. Like nothing against these markets if people are listening. Like a Fayetteville, we're not going to look at just because it's primarily driven by military, and we're just not comfortable with that necessarily.
Right.
We're looking for positive population growth, positive job growth, any job announcements. And again, diversity of employers. So, I mentioned Charleston, it's a port city, big tourism base, big manufacturing presence. And obviously I'm picking a lot of markets that are, they're maybe sexier, but they're very competitive for that. So that's the trade-off.
Sure. And guys, jobs are the number one thing to look at when you're buying multifamily. And we don't want any one-horse towns. And the horse can be a military base, because if the horse dies or runs off, you're in big trouble. And so we want to see not just employer diversity, we want to see different industry diversity as well. And that's when you have a secure, safe bet. And so, that's one of the big things that you want to look for. So population growth, job growth. All right, fantastic. So what sorts of assets now do you target? What size range, and what are some of the returns that you cash on cash and IRR numbers that you like to see or feel like are realistic when you're looking at a deal?
Right. We do have a bit of a large range. We're in the $5 to $20 million deal size. We just think that the flexibility, especially now, is something that maybe we could offer that other groups don't offer. So maybe a little bit of a competitive advantage in the deal size that we'll chase. Return-wise, we're looking at deals on, call it a 5 to 10 year time horizon, and we need to be in the 14 to 16 IRR range, which is more moderated than we were a year ago, if you ask me that question. But I think it's realistic to have a little bit more moderated expectations these days.
Yeah. Do you work strictly with broker relationships? Do you do any direct to seller marketing of any kind? How do you find your deals?
I tried the direct to seller side. We did some direct mail. I haven't had a huge amount of success with it. I do think it works, but maybe I didn't commit to it long enough, or I think that's what people say. It's typically the consistency on that side. But I will say 2 of the better deals that we've done have come directly from property managers and not through brokers.
Right.
Which I think they're rare, but I think they can definitely happen. And in both of those cases, we paid very healthy wholesale fees to the property manager that got us those deals.
Sure. Worth every penny. And I've got someone in my mastermind that got, I think a couple thousand doors from his property management company. So, they can be very lucrative relationships. So talk about how you develop your broker relationships, and are you involved in that process?
Definitely.
Okay. So talk about how you find the brokers and how you, stay in communication, some of the strategies you use to make sure you're top of mind.
Sure. I really, really try to just it's all about consistency in my mind. I think, not to insult brokers, but it's easy to have like a short-term thought process with brokers that they'll maybe have an interesting deal. And if they talk to you yesterday, you'll get it before the other guy that's just as qualified as you are. So on an ongoing basis, we have our short list of brokers that we've either worked with before or have a really good rapport relationship with that we'll just touch base with. It could be every 2-3 weeks. We took a trip it's probably about a month and a half ago, where we were in Tampa, Charlotte, Greenville, Charleston, all in a week. And we weren't even going there necessarily with the intention of looking at deals. It was really just to be a face in front of a broker, grab a coffee, grab a beer, and sort of smile and just look and see deals. We're absolutely offering on marketed deals. I think our expectation is we're probably not going to win those offers, but I do think it helps continue to build that relationship and be able to hang around the hoop if something falls out.
Can't stress that enough, guys. When you select a market, you of course you start those relationships over the phone. You get to, you ask them to send you deals. You're very responsive, but you've got to go break bread with them. They've got to see that you're real and not just one time. I mean, you start, yes, you got to go meet them, and then they see you're real. They see your passion, your integrity. Then really the clouds part, and you start getting more activity from them. But then even well into it, like you are, Josh, you go back down, and the sole purpose of reigniting those relationships, keeping them warm, and keeping yourself top of mind. Wouldn't you agree?
Totally. Couldn't agree more.
Okay. And so talk about now how you develop your, how do you select your third-party property managers? Let's go there for a minute. So, you're obviously, how do you find the best people in this business? Let me ask that question.
Well, I would say this. It's been referral driven.
That's what I was looking for. And that's the answer I was looking for. I just wanted to hear someone besides me say it. Okay, so you asked for referrals, and that's the answer. So, but do you work with some of the larger players in the property management space? Do you like the smaller companies? What do you look for?
So we're doing both. The Panama City deal was actually managed by a really large manager. I think they managed 40,000 units across Florida and a handful of the Gulf Coast states. And it worked. And they took on a 70-unit deal and did a really, really good job. And then at the same time, like in Charleston, we work with a smaller manager that manages about 1,000 units, really only in Charleston. I think there's a case to make in both directions.
Sure.
I think there's definitely pros and cons. I could say.
Well, let's speak to that because I don't think I ever have on this show, and I mean I could speak to it, but let you speak to the pros of a larger company. Let's start there.
Pros of a larger company, I think the scale behind it. So you lose an employee, you lose a maintenance person or a salaried staff. They're able to tap into
plug and play.
And to me, that's the most important piece of every deal are the people.
Yes.
So to be able to insert and replace that easily until they find the right formula, I think is incredibly valuable.
The right person, really, for that role, and sometimes you go through 2 or 3 to find that person for that asset. Okay, that's a great plus. What else?
I think on the plus side, they're typically very good at removing the noise in terms of contractors. They're going to have contractors that they're going to set their standards from insurance, from different deals they've worked with, where it's going to be a shorter list. They're not necessarily going to be the most cost-efficient list, but no. I do think they inherently are going to bring a greater quality product at the end of the day.
No question. I'll add a couple of things. One, they'll typically have a great training program for their people as well. These people that they're putting on your assets, so they're very well trained. There's typically a training department. There's consistent training, which is so critical. Additionally, they'll typically have a great marketing training program as well, and they'll have maybe a whole marketing department that will help you market your asset very, very effectively. So there's just a lot of component pieces in a large management company that can be very in a large management company that can really help. So now let's talk about the advantages of a smaller management company.
So I think you could get more interest and care, or as maybe to rephrase, the smaller management company, the owner of that management company is still our direct point of contact. Mm-hmm. And she's someone that has 20 plus years of experience in that business. So you're getting a senior level person that's in the weeds with you in a way that you're not going to get that same person as your day-to-day contact.
Sure.
I think they often will know the one-off maintenance guy that might be able to come over and fix something for a couple $100 and do it a little bit leaner. But I think the risk is that it could be challenging for them on the staffing side to be able to retain and be as attractive to the better base of employees, offer the same employment packages, cost, all of those things.
Yep. Couldn't agree more. Okay. So, what's you said 5 to 20 million. Well, let's back off for a minute here. Let's talk about you for a second. So, one question I love to ask is if you could go back in time. I know you're in your early 30s. You go back to your early 20s. Is there anything you might do differently with what you know now? Something that might inspire or put a bug in somebody's ear that's at that place in their life that's listening?
So it's a good question. I think my answer would be just the education side and absorbing that much more. I would have, out of college, worked for a real estate investment company that much sooner and learned it from, I'd try to get a job at a Greystar or Greystone or from either perspective and just see how the best people are doing it. And investing and learn from that level. And at the same time, I would still complement and take that leap on the entrepreneurial side and jump in young. I think, you'll force yourself to make it work. I think you need some base to work around to be able to take that leap. But ultimately, the leap needs to happen to be able to put together a portfolio.
Well, I know, at least I'm guessing that you're super analytical. And so I'm sure that first deal, maybe even the first larger deal, was probably a real push, yes? I mean, it was a real stretch for you to push through that fear muscle and
Definitely.
All that, yes?
How could you sense that I was more adequate?
I can just say, you talk to as many people as I do, you feel it. And you said that and it was obvious by your role with on the acquisitions team and the deal analysis team. And so I can tell. So how did you push through that fear, brother? I mean, what did you do so for the people that are listening that are in that place, that are maybe a little more introverted, not as comfortable starting new relationships, how did you push yourself out of your comfort zone?
I think so I'll say this, even my first deal that I did, we still raised, or I raised a little bit of money for that deal.
Wow.
Which again, I would never suggest that to anyone to do. Maybe I was young enough and dumb enough at the time to say, okay, let's do this. What I did in that case, I also invested and I put my money before everyone else's. But
back to my question. How'd you push through the fear? Was there fear?
No, there was definitely very much so fear. I think it was more of a assess individual risks and attempt to verify with whatever supporting cast I can to push through that fear.
So you did it analytically. I mean, you literally you did a Ben Franklin close. You looked at the negatives, the positives, and the positives outweighed the negatives. So you did it there. So it wasn't as much of an emotional decision as it was a tactical one.
I try to always make it tactical. I think from a personal improvement perspective, I think there's some improving I could do on the other side, but I've got spreadsheets all over the place.
Okay. All right. That's interesting. And that's fascinating, actually, because I'm all about the mindset piece of this. It's all about, how do you get uncomfortable, push through limiting beliefs, fears and take action. And you did it very, very systematically. So that's very cool. And you added value. I promise you added value to some of the people listening. And so, if it checks off all the boxes or most of the boxes, then you have no excuse other than to pull the trigger. Yes.
I'll say last sentiment on this topic, just to throw in there with every deal I've done. There's always going to be your detracting things.
There'll be some hair.
There's something that swirls that makes you think, am I sure I want to jump?
Right.
And ultimately, no matter how much you try to mitigate that risk, you do have to be willing to just leap and believe in the overall coming together.
Yeah.
So,
and I'm sure the mentor helped a lot with that, of course, to give you comfort. Yeah. So tell me about a time you made a mistake, a real doozy.
Well, I would say the biggest mistake that we've dealt with has been that first year, just the expectation that you set on the first year. I think that no
with
matter
your numbers, maybe you underestimated the
Yeah.
vacancy and the cap or the capex or how quickly you could execute.
Turnover, bad debt, assuming you step into more of a stabilized product than you are, because there's only so much. You could be as diligent as you want verifying the deal up front, but there's still going to be some unknowns that float out there.
Yeah.
So I would say just the expectation that I may have set with investors for that first year being potentially more of a stable year than it ended up being, and that becoming more of a restabilizing year. I would say that would be the one, a mistake that I regret and something I could have very easily gotten ahead of and not turned off anyone from the deal.
Okay. Yeah, that's great lesson learned. Let me ask you this. What kind of person do you think is best suited for multifamily active investing?
I'd say a business owner. I think someone that really understands the people side of the business, that could read individuals well. And having a construction background certainly cannot hurt. But with each deal, it's almost like its own little mini business that you're running.
It really is. You create a business plan on. I mean, it's really your plan for the property is a business plan. So you're absolutely right. It is a little mini business.
Right.
Yeah. What's the most challenging part of the job that you do now? I mean, what do you think is the most challenging, Josh?
So, I always bucket it in two different buckets. For us, at least, every day we have.
I'm sorry, I didn't hear you. What did you say? I'm sorry.
All the work that we do day to day falls in two different buckets. It's either the deals bucket or the money bucket. Right. So we're either chasing opportunities or building up an investor pipeline or cultivating that pipeline. Right. I guess the challenging part is that when we do have a deal, the rest of the world slows down for us. We're a company of two people and a little bit of part-time help. And we completely stop and make sure that deal, is vetted and tested and everything. So
you have families and everything else that, obviously, right?
So the balance, and then once we close and start implementing a business plan, then we want to reset maybe on the acquisition side and other things. So really putting it into a consistent flow of business creation, I guess, may be a challenge that I would call out.
Yeah. That's good. That's helpful. So, I've got a lot of aspiring investors that are listening right now. What would you tell someone that hasn't pulled the trigger yet about this business? What words of wisdom?
My maybe it's dumb advice, but it's my go-to. It's I'm very, very, very location oriented. I think that tends to cure most mistakes. I started in a rougher area, rough submarkets, difficult tenant base. I much rather say spend a little more to win that deal. That's walking distance to whatever it might be,
Starbucks, whatever, right?
Then try to jump in on your first deal that you're going to be active about in next to a pawn shop.
Right. No, that's sound advice, brother. That's sound advice. Well, listen, Josh, you've added a ton of value. I really appreciate you coming on the show. And, it's DXE Properties, guys. And I really, it's a pleasure to meet you. And I'm excited to see where this goes for you, my friend.
Well, likewise. I appreciate the invite. Thank you.
No, my pleasure, buddy. Well, you take care. And I'm sure we'll cross paths again soon.
Hey, thanks for watching. Please subscribe to my channel. And if you listen to podcasts, join me on iTunes, Stitcher, or wherever you listen to those podcasts. Just search for Lifetime Cash Flow through Real Estate Investing.